Hey everyone, my name is Alan and I am the founder of Dream Big Live Tiny Co., a media website that follows and documents the tiny house movement and all the incredible people that are a part of it. Several years ago, I quit my consulting job to pursue a life full of adventures in pursuit of my own freedom. After traveling around the world for almost a year, I sold most of my belongings and moved into an 160 square foot tiny house. Now, I'm your host of the Dream Big Live Tiny Show, a podcast showcasing incredible individuals and families living with less in pursuit of more freedom. Hey guys, I hope you all are having a wonderful start to your weeks. Today we are recording episode number 3 of the podcast, and today we are covering a very hot topic in the tiny house movement, and that is trying to decide whether we should finance or pay cash for our tiny houses. And I think this really stems from the lack of financing options out in the market right now. And not only that, but the implications that it means for our lifestyles and our financial security moving forward with either of these decisions. Some people will seek out a tiny life exclusively to be or become debt-free and will refuse to finance any portion of their tiny house. Other people don't have enough cash reserves lying around to pour tens of thousands of dollars into purchasing a tiny house outright. Others who are DIYing their build have the luxury of spreading out their expenses and investments over the course of their build. And others are in the position to go in either of these directions, but really need to consider and weigh the pros and cons of each of these decisions. But first and foremost, I think you really need to be self-aware of where you are financially right now at this point in time, and if you can even afford to pay for a tiny house outright. If that's not the case, then financing is going to be your only option. Now, there are a bit of options when it comes to financing, and this ranges from institutional funds to private funds to maybe your friends and family helping you out. But let's dive into this world of financing for a bit. Assuming you don't have 100% of the funds for your tiny house build, you're going to have to borrow institutional money to cover the remaining portion of the price or the cost of your tiny house. So unlike a traditional home purchase where you can take out a 15 to 30-year mortgage for a house on a relatively low interest rate from 3.5% to 4.5%, depending on your credit profile, financing for tiny houses is actually quite sparse. You'll have a bit more options if your tiny house is RVIA certified, but that also comes with some inconveniences such as higher interest rates and shorter loan terms. So for those of you that are unfamiliar, RVIA, or the Recreational Vehicle Industry Association, is an association of manufacturers and part suppliers that account for most of the RVs that are manufactured in the United States. So just to give you an idea of how financing would work, let's run through a quick scenario of a purchase of a $45,000 mid-priced tiny house. So let's assume that you have $10,000 in savings sitting in your bank account that you are willing to put down as a down payment for this tiny house. So you'll need to finance the additional $35,000. Now let's assume that this tiny house is RVIA certified and that you're going to be taking out an RV loan. So at the current RV loan rates as of today, December 2nd, 2019, a $35,000 note at a term of 36 months or 3 years will have an interest rate of anywhere between 4.5% and 7.6%, depending on your credit profile. So of course, the higher your credit score and the better your credit profile, the lower interest rate you are going to be getting because the institution sees you as less of a risk for default. So with this loan, your monthly payment is going to be somewhere between $1,040 and $1,090 over the course of that loan. So the total interest paid in those 3 years at 4.5% is going to be $2,500. And at 7.6% is going to be $4,300. So alternatively, if you choose to extend that RV loan to 84 months or 7 years, which is about the maximum that most institutions will lend you money on an RV loan, then you're looking at an interest rate of anywhere between 6 and 9.1%. So with this longer loan, your monthly payment is going to be somewhere between $511 and $566. And your total interest paid at about 6% interest is going to be $8,000 over the course of the loan, and at 9.1% is going to be about $12,500. So the longer your RV loan, the lower your monthly payment. but at the expense of a higher interest rate, and ultimately you're going to be spending a lot more money to own your tiny house. Now, if your tiny house isn't RVIA certified, you're going to have a lot less financing options even then. So you're basically going to be limited to some institutions that are willing to lend on just a traditional tiny house or a personal loan at a higher interest rate. And that's just because institutions lack standards to appraise and assess the value of a tiny house that is not built to those specific certification standards, which isn't a bad thing at all. And we'll touch on those things a little bit later on a separate episode. Ultimately, there are some major pros and cons to buying an RVIA certified tiny house. And one of those cons is that you are a lot more limited on where you can park an RVIA certified tiny house. And you're pretty much going to be restricted in length and where you park to an RV park. Now, tiny houses that aren't RVIA certified have a bit more flexibility with zoning regulations, but there are some major drawbacks as well that we'll touch on later on. The biggest advantage to financing is that you can end up with a higher priced tiny house than you could possibly afford if you were paying in cash. For example, if your tiny house budget is $35,000, you could pay for that house outright, or you could use that money or a portion of that money as a down payment on a higher priced tiny house with more features or more space, and you expand your horizons to what you can possibly build or buy, assuming that you have a good credit score and a good credit history. However, if you do have the opportunity to pay for your tiny house outright, then you should definitely weigh the pros and cons of each option to see what makes the most sense for you. Generally, paying for any sort of vehicle, RV, or tiny house with cash is favorable to financing, but that's definitely not always the case. The best example I could give you is if you qualify for a favorable interest rate through financing. In that case, paying with cash may not be the smartest thing to do if the loan on your interest rate is less than what you can expect your return on other investments could be. If you finance, the bank will lend you the money and you will basically get to keep your cash to use for other projects and other investments. For example, let's just say you want to buy that $45,000 house that we spoke about earlier and you have the cash ready to buy it. If you want to spend your cash, that's great. That means you won't have a monthly payment or any interest to worry about, and you'll own your home outright from day one. But let's just say you shop around for an interest rate and financing options, and you end up with that great 4.5% interest rate over a 3-year term if you put $10,000 down. So you're going to be financing the other $35,000 from the bank at 4.5%. In that case, you're going to keep the other $35,000 in cash, and even though you have a monthly payment over the course of those 3 years, your interest is going to come out to about $2,500 total. Now, the question that you must ask yourself at this point is if it's worth it to you to spend $2,500 in interest to have the opportunity to keep those $35,000 in the bank to use for projects or other investments, rather than tied up in your tiny house. Now, in economics, we call this opportunity cost. So the opportunity cost of putting in that $35,000 into your home when you pay cash for it is the potential return that you could have earned had you put that $35,000 elsewhere in another investment, whether that be real estate, stocks or bonds, a new business venture, etc. If you are confident that you could generate a return higher than the interest rate of your loan, in this case 4.5%, then you may be better off in the future by financing this tiny house today. However, if you are risk adverse or foresee some unfavorable market conditions, market corrections, or declining returns on investment, then you may be able to sleep better at night and have more peace of mind knowing that you paid for your tiny house outright and you own that from day one. So ultimately, at the end of the day, you have to make that personal decision on whether it is better for you at this point in time with your current financial situation to finance versus paying cash for it. If you don't have the money outright, then financing is going to be your only option. And unfortunately, with tiny houses, we're really limited to higher interest rates unless you have some generous friends and family that are willing to loan you some money at a lower interest rate. Of course, the better your credit score, the better your credit history, the more favorable interest rates you're going to get, and the less interest you're going to pay over time to own your tiny house. If you have cash available to purchase your tiny house in its entirety, then I think you really should weigh the pros and cons. I don't think it's necessarily the best option to always buy it outright. I think it depends a lot on what are you saving up for in addition to your home. Are you saving for retirement? Are you saving for any trips? Are you saving for any investments? Are you saving for any sort of changing market conditions? Do you expect the bull market to continue for a long time, or are you expecting a bear market coming up soon? So all these things, I really do think that you as an individual, you as a family, should be thinking about when making this decision. Try not to make a fully emotional decision. I know a lot of us think that tiny living is all about becoming debt-free, even though that's definitely a factor. You may be better off financing over paying cash once you run the numbers. So just rely on the math and make a logical and emotional decision. And I think you're going to be a much better place making that decision with some sort of substantiated claims that you've researched and really understand well. In my case, just to kind of give you some context, I was in a position where I had saved up all the money that I needed to pay for my tiny house outright. And I did have a bit of a sliding scale on how much I was willing to go over that budget. The problem with me is that I was starting to look at used tiny houses, and new houses were coming up every single day or every other day. So I really didn't know what else was around the corner, so to speak, right? So I was looking at houses that I was content with, that I liked, that I didn't like so much, and I had ran a lot of the numbers, and for me it made the most sense to finance the tiny house because I was pretty confident, or I am pretty confident still, that I could generate a higher return than the interest rate that I expected to receive for the loans that I was planning on applying for. So that spread was a good safety net for me, and I was confident that I could make it work. However, with me, the situation was that I ended up finding this tiny house that I'm living in right now all of a sudden, and even though I was expecting or planning to finance, the financing process definitely isn't an overnight process. It takes a while to get all the paperwork together, to get approved, to get the funds. And so I was looking at a 4 to 6 week lead time. And because I was looking at houses kind of across a different range, I didn't want to apply before I found the house. So what ended up happening is that I found this house that I wanted to buy, and I was afraid that I was going to lose the house had I, at that point, started the financing process and had to wait a month to 6 weeks to get the funds and then transfer it and make the sale. The opportunity cost at that point became that if I didn't buy this tiny house, that I would have to then buy the next best option, which I didn't even know if that was going to be better or worse in terms of the needs and the features and the functionality of the house, right? That was the risk that I was willing to take, and so what I ended up doing is just paying for this house with cash outright and not financing it. There's some pros and cons to it. The con is that I drained those cash reserves on the house, and so if some sort of investment opportunity comes up where I need, a couple $10,000s, it's going to be difficult to come up with some additional money when the money is sitting in the equity in this house. You know what I mean? So it's going to take some time to build those cash reserves back up so that I have the opportunity to jump on immediate investment opportunities. So that's sort of the downside, is that you kind of put yourself a bit more on the sidelines. I mean, depending on where you are in life. I'm 25 years old, so I don't have a whole lot of money. A lot of the money that I'd saved up went into this house. So for me, draining a significant portion of my cash reserves puts me a bit more on the sideline when it comes to any sort of investment opportunities that may come up in the future. But that's something that I have to live with, and that just means that I have to work very hard to save diligently to build those reserves back up. Now, the huge benefit, of course, is that I don't have a mortgage, I don't have a loan, I don't have a monthly payment, I'm not paying interest every single month, so I am debt-free when it comes to this house. And that's an incredibly great feeling. It relieves a lot of pressure when it comes to day-to-day life and monthly expenses and things like that, and honestly makes my living expenses very, very low compared to a lot of other people. So that's something that I had to assess. I had already sort of ran the numbers long before, but when this opportunity came up at that point, it almost changed my entire thought process, and I had to, on the fly, make the best decision that I thought, was going to put me in the best position in the future. And that's what I ended up doing. And I think that's what every one of you should be doing, prior to your tiny house search, so that you don't get too caught up in this design process and in the search for a builder or a tiny house that's already built. You basically know what you're going to be doing. And you may have a situation that comes up like it did for me, where things change in a matter of minutes, in a matter of days. So that's basically it. If you guys have any questions, please feel free to email me, alan@dreambiglivetinyco.com, or send us a DM at our Instagram page @dreambiglivtiny. So that's it for this episode. And next week, I'm going to be bringing in our very first guest of the Dream Big Live Tiny show, and I am super excited to be sharing her story with you guys. So stay tuned. I will see you guys in the next one.